In the alternate version of exercise 10-11, we're picking back up on our installment note with Eagle. We already done the calculations before to figure out of our $35,000 borrowed on the note, what is the amount of the equal payments each year at the end of 4 years? That was $10,333. We also made the determination in 10-10 of what amount of that is interest expense each year and what amount of that is a payment or a debit to notes payable. So we've already done the bulk of our calculations. What we're asked to do in this problem is record the journal entries. First, we want to record the journal entry for the loan on January 1st, 2016. On January 1st, we received cash. Cash is an asset, so we're going to debit cash for $35,000, the total amount of the note. On the other hand, we have an IOU or an obligation for notes payable. We increase liabilities with a credit, so we'll credit notes payable also for $35,000 on January 1st. Now we're going to fast forward to our first payment made on December 31st, 2016. Keep in mind that that payment is going to be a combination of both a payment of interest and principal. In particular, the interest amount we already identified before in the first year is going to be $2,450. Interest expense is an expense. We increase it with the debit, so we'll debit interest expense by $2,450. Also, a portion of the payment, in particular $7,883, is a reduction on the note. So we'll decrease notes payable by debiting notes payable for $7,883. The other side is we're reducing cash because we're making a payment. So we'll credit cash by the annual amount of $10,333. I'm going to go through the next ones fairly quickly because we've already done the calculations. At the end of 2017, we're debiting interest expense again, but this time for a lower amount of $1,898. Debiting notes payable, but for a higher amount of $8,435, continuing, however, in each payment to credit cash by that equal annual payment of $10,333. 2018, debit interest expense for $1,308. Debit notes payable for $9,025 and credit cash for $10,333. The very last year, our final payment is going to be a debit to interest expense for $676, a debits to notes payable, which finally pays off our whole entire note amount of $9,657. Keep in mind, we've been paying a portion of it the prior 3 years. There was only $9,657 left, so we're going to debit notes payable by that amount. And last and not least is again crediting cash by $10,333. So our credit to cash in each of these equal payments is going to stay the same because it was equal payments. However, we'll point out again, our debit to interest expense is going to be declining over time because it's being calculated on a declining outstanding balance because we're paying a little portion at a time. On the other hand, because we have equal payments and our interest expense portion of that is going down, the amount we debit or reduce notes payable by each year is going to be increasing. So our debit to notes payable is actually going to be increasing over time. We're paying a little bit more of the debt down each year as we get closer to the end.